Just like commodity, stock, and Bitcoin exchanges, the international gold and silver markets are driven by specialists, or market makers. In the gold market, there are 5 major international market makers who essentially operate as a single group. The silver market follows a similar structure, which is why silver prices usually track gold. However, silver is far more volatile, often experiencing aggressive surges followed by devastating crashes. This happens because silver market makers cannot always hold the line. In the gold market, the demand for physical delivery is nearly zero. It is largely a paper game, which keeps the pressure low. Silver is different. Beyond its financial attributes, it is a vital industrial raw material used extensively by both China and the US. It is a physical commodity. When long positions, particularly those driven by the Asian market, demand physical delivery that exceeds the physical inventory of the New York Mercantile Exchange (COMEX, the exchange and its market makers are pushed to a breaking point. To survive, they are often forced to play dirty. A classic example occurred in 1980 and 1981 with the Hunt brothers. As the wealthiest men in America at the time, their massive buying forced the Federal Reserve to intervene. Fed Chairman Paul Volcker announced aggressive interest rate hikes, initiating a tightening cycle to strike down the market. If they hadn't, Colorado Max would have gone bankrupt, likely dragging down at least 2 major Wall Street financing banks that were heavily involved. To save the casino, they had to crush the longs through forced deleveraging until investors doubted their own lives. This is why silver often rises late in a cycle, but falls first and hardest. From a macro perspective, these market shifts reflect challenges to US national power. The last great bull market for gold and silver occurred in the 1970s and 80s, during the peak of the Cold War. At that time, the Soviet Union's conventional military strength and nuclear throw weight actually surpassed those of the US. The US was reeling from its defeat in the Vietnam War, and its presidents were struggling to maintain authority. Consequently, the US dollar remained extremely weak throughout the 1970s. It wasn't until President Reagan's Star Wars program years later that the Soviet Union was eventually outmaneuvered. Every time the US-led global order is challenged, the dollar softens and gold strengthens. After the 1980s crash, gold prices remained suppressed until 2004. That year, the China Gold White Paper was released, predicting a century-long bull market for gold based on the rise of China. AS made in China dominates the globe, and China emerges as a true challenger to US hegemony. History is repeating itself. Wealthy Chinese investors will eventually realize that holding physical gold and silver is a far more reliable way to preserve wealth than investing in US treasuries.